Okay, I'd like to take this opportunity to welcome everyone to our sneak preview top 10 stock picks webinar. You got John Hopkins here. Great to have everybody joining us today. Quite a day, actually, when you think about it. The NASDAQ hitting an all-time high, just powering into the close. And I'm sure, Tom, you may have something to say about that. Anyways, we got a great crowd tonight. A couple of housekeeping things real quick. Number one, this event is being recorded. For some reason, you've got to leave early. I think we'll be done with this probably by 5:30. That's what I'm thinking. For some reason you have to leave, don't worry, it's being recorded, and we'll make sure everybody gets a copy of the recording. Sometimes you might run into a technical, audio issue, visual issue. Don't worry about it because we'll have that recording. We record on the cloud, which generally gives us pretty flawless product at the end. So no worry about that at all. Tom's going to jump into the meat of this thing. In just a minute, there's something I want to share with you real quickly, just before I turn it over to Tom. We do this every time we have one of our webinars as an opportunity to give anybody who wants to upgrade to an annual membership a great deal. I'm not going to get into this. I'll spend a little bit of time when Tom takes a break later, but I want to let you know you can find this on our site. So if you go to our site under the webinar special, it'll give you all the details. It's really a tremendous way to save a lot of money over the course of the year. But another alternative for those of you who want to just give us a try is we have our 30-day trial, our no-cost trial. You sign up, it costs you $7. You get the $7 back in a refund promptly, and you have 30 days to try us out. This becomes significant because after today, our next big event will be the 19th, when Tom actually unveils his top 10 stock picks, which happen to be 4 different categories, 4 stocks in all. That one you have to be a member for. Tonight, it's open to the public. Anyways, check that out. It's certainly worth giving us a try. And I'll go over that a little bit more with you later. Anyways, I know Tom wants to get started on this thing. So Tom, if you're ready, I'm going to turn it right over to you.
No, you can go ahead and keep talking.
Okay. What a day, huh?
Wow. Yeah, quite a day. I mean, the market just has its head down, and
yeah,
I don't think a lot of folks get what we're in right now. I really don't. I think the market's going a lot higher, and I've said it on many occasions. I said it throughout 2019, even when the market was struggling, that it was more of a Fed problem than anything else. And, now the Fed's behind the market. The market's actually begging the Fed for another rate cut. And all that's going to do is just make the earnings growth even more valuable.
Right.
So I think that's why you're just seeing folks, pouring in hand over fist into equities. We're really just not getting much of a pullback. Even when we've gotten to the point where sentiment's been so stretched, would we have a 3% pullback and then right back to all-time highs quickly? So I think that the market's set to go a lot higher. I really do. I just think that the fact that we've got the Fed now very dovish, and inflation really more disinflation than anything. And I've had questions. What's disinflation? What's the difference? Why isn't it deflation? Well, as long as you have inflation, disinflation is just a lowering of inflation. So we still have inflation, but it's below the target level of 2%. So it's actually been a disinflation scenario. Deflation would be going below 0, and the Fed definitely does not want that. And so in order to avoid that, they're going to want to inflate the economy, and the way to do that is to cut rates, weaken the dollar, which then in turn raises commodity prices. So I just think that the market environment in my lifetime, this is the only time that I've ever been involved in the stock market where we have had the Fed very dovish, a growing economy, and interest rates near historic lows and probably going lower. And I've said this on many occasions, but I know we probably have some new folks in here. my background as a CPA, when I was in public accounting, I had to do valuations from time to time. And what you do is you take future earnings growth, projected earnings growth, and you discount it back using current market rates of interest. And when you've got interest rates as low as they are right now, you're really not discounting them back much. So when you see earnings growth like Apple's been showing, and Microsoft and Tesla and Amazon and Google and some of these others, that's why everybody's bidding the shares of these prices up. The future earnings growth is incredibly valuable in a low interest rate environment. And I don't think this is anywhere near being done. But just my opinion. I could be wrong. I've been wrong before, but that's the way I see the market right now. So I'm not at all surprised. Let me go ahead and pull up a couple things here. We're going to get this started. First thing I want to do, and anybody who maybe is not familiar with EarningsBeats, I would say kind of like the engine of EarningsBeats is the strong earnings chart list that we keep. And any of our members that are also members at Stock Charts, if you've got at least an extra membership at Stock Charts, what you can do is I go through, I research hundreds and hundreds of companies, looking at earnings reports each quarter. I find the ones that beat top and bottom line. I look at their charts. If I like what's going on, I annotate the charts, put in a couple key support levels, and put this chart list together. So it's like this huge watch list of companies that have beaten top and bottom line estimates. And then the chart styles that I use are, just comparing first looking at the stock, and then also looking at its industry group, the relative strength of its industry group. I'll get into it in just a minute. So the strength of its industry group, absolute strength. And then I look at the relative strength of the stock versus its industry group, the relative strength of the stock versus the S&P 500, and then the relative strength of the industry group relative to the S&P 500. This is just a very quick look. You can get a sense of whether or not you're in a good stock or a bad stock. And so I want to go ahead and show you how easy this is if you're a Stock Charts member, and they've got a 30-day free trial. I don't get paid anything by Stock Charts, by the way, but I've been a member there for a long, long time. And I remember I used to use Scan Engine. I've been a long-term client of Charles Schwab. And I remember I used to use their platform, Schwab Pro, or I don't remember what the name of it was. It's been so long now. But I used that for a long time. And I started using Stock Charts Scan Engine, and I stopped. I've never used any of my broker stuff anymore. I strictly use Stock Charts. And so being able to keep and organize and annotate charts and then be able to run scans against it, it's really powerful. And so what we've done is anytime I update the strong earnings chart list, I'll send out to members. Now, it used to be I would have to go in, and it was crazy. Let me show you what I would have to do. I would have to go in here. So let's say I was just going to send this list out, the major market indices. I would go in here to edit, and I would click send to friend. And if we had, however members, Stock Charts members we had that wanted this list, we had to type in their user ID one at a time, or copy and paste one at a time. And if the chart list changed in 3 days, we had to do it all over again, because the chart list isn't in your account's not going to update. It's going to update in my account, but in order for you to get it, I'd have to send it to you again. So it was an incredibly tedious process. And so Stock Charts has changed all that for us, thankfully. And so now we've got a chart list where I can now send to members. So this came, I'm a member of EarningsBeats. And so when I send something out, I like to make sure it comes through properly. So this was today's daily market report. I send out a daily market report every day. And here was the strong earnings chart list. And so all I have to do is click on that and type in my password, and it comes to this point. And now what I can do is I can save to a chart list. So I can either click on new list, I can merge this with another list that I already have at Stock Charts, or I can replace the list. And so let me just, what I would normally do is click replace list, and then I would go into my account. I'd go down here to strong earnings. This is automatically checked. The default is to include the chart styles, and then you can save results. and you just click on it and it updates your account. So every member now gets this daily market report. And so the link goes out to everyone simultaneously. So I don't have to, we no longer have to, and did you see how quick that was, by the way? What was it, 15 seconds, 10 seconds? I don't know. But now we don't have to send out individually to everyone. So it's made our life a lot easier, and we've gotten some feedback from members that this has been a really easy process for them. So that's all you need. The link, the password, boom, you load it into your account. I do all the homework for you. All of the reviewing of the earnings reports, looking at the charts, annotating the charts, saving the charts, and then literally send you a link and boom, you click and it's all into your account. So whatever you pay us, the annual fee that John was showing earlier, that is 1 year worth of this alone is worth the price of admission, in my opinion. But anyway, just wanted to let everybody know that that was sent out today, and you can look at that. You also can download chart lists from our website. So once you've logged in as a member, left-hand navigational panel, there will be under members, it'll say chart lists. And if you click on that, it'll take you to a page where you can download the chart list. Okay, so I wanted to just make sure everyone was aware that that new Strong Earnings chart list is available. There are now 269, and by the way, if you don't have a chart list, or if you don't have a stock charts account, and you can still get this link and pull this up, but if you're not a member at Stock Charts, you're going to have ads up here, probably ads on the side, and I'm sure some kind of marketing asking you, to subscribe, get a free membership or whatever. But you could literally go through here and just look at each one of these. And you can see here are all the chart styles that I was referring to. So for instance, with Nutanix, NTNX, you can see here's the price chart of the stock going back to August. It's been in a nice uptrend. Here was the recent highs coming in here. So that was marked as now support. Here was the bottom of this gap. So that's the other support line that I've marked. So those are a couple levels that I would be, maybe looking at if the stock were to come back down in that area. But you can see it's part of software. So software has been going up. The stock relative to software has been going down the last 2.5 months. And it's mostly sideways the last 6 months. So it just tells me it's kind of going along for the ride, which isn't a bad ride, by the way, because software has been performing extremely well. You can see software has been outperforming the S&P 500 pretty wildly. NTNX has been underperforming a bit, the group, and that means it's been going basically sideways versus the S&P 500. So it's an okay stock, but it has beaten earnings and revenue expectations. It's got an annotated chart here, and it could break out and start leading. So we don't want to wait for the chart. I mean, it's not a bad looking chart. Pretty nice uptrend, I would say here. But again, it's not one of your strongest software stocks. But if you're not a member at Stock Charts, you can get this and go through and look at these, but there are 269 of them. So if you are a member, you download it into your account, and you literally can run scans against it. The other thing that's pretty cool is that you can go into the Strong Earnings chart list once it's set up in your account like this, and I can view all, and then I can do a summary, and it has every one of the stocks in here. I can sort it by scooter, so I got the top scooters of all the stocks in here. This was part of what I sent out in the daily market report today to members, was just, hey, if nothing else, just recognize the top 3%. Looking at the scooters from 97 and above, I actually sent an image of this out to members so you can look at it. These are really the companies that I would be focusing on. I mean, obviously there are a lot of others down here that are going to be very strong as well. And you can see how many stocks are on here now. Quite a list to go through, potential trade candidates with annotated charts on all of them. So once you've got this in your account, literally you can pull up any of these, Tesla, and you can take a look at the chart with annotations. Now, there are multiple gaps and everything else. You could put lots of different support levels on some of these charts. But I put a couple on here that I think are pretty important in the event that the stock were to continue to pull back. And then you've got a stock like AMD. all of a sudden today, great day, up 5%, closed at a new high. This was a new closing high for AMD. But it had pulled back. Where did it pull back to? It pulled back right to this gap support level. Now, if it had broken below there, maybe it would have gotten to this breakout area at 42.50 or so, but it never went below 46. And now it's turned back around. Volume's starting to pick up, and it looks like AMD's ready to go again. So really important to maybe focus in on some of the stronger stocks on this list. All right. So I wanted just to make sure everyone was aware of that. And how you can do that. I mean, there's so many different things you can do here. You can, in addition to sorting by scooter, I could then sort by industry and then by sector. So now I've got communication services. Then I've got the industry sorted by in alphabetical order. And then the scooter within the industry is sorted highest to lowest. So if, for instance, communication services, you're looking at internet, you could quickly zero in on the best performing internet stocks on the list. Same goes with all the other areas. Another cool thing about this is I could go back and say, all right, how have these stocks performed over the last week? So here it is. Let's sort it by percentage change. So you can see Biogen's been up 24% this week, Synaptics 20%. But which stocks have pulled back? Because if these are pretty good stocks, maybe I might find some opportunities looking at the ones that have pulled back. Now 28% is probably going to be a little high. I'm not usually looking for stocks to pull back 28% in a week. But, maybe MNH. Actually, CLS, I think, was an interesting chart. I looked at this earlier. So here was the breakout at $8.05. Here was the pullback. We've held it on multiple occasions, 805. We break out. We come back down. I think this is a pretty key area. We closed at 805. So by just simply looking at this could be an opportunity if you, are a little bit more aggressive. Here's a stock that was trading up around $9.30 a little over a week ago. Now you can get it at 805. And, it was just easily found just by using this chart list. But anyway, so that's that. Also wanted to mention, let's see here. I want to just briefly talk about the portfolios because this is the sneak preview of next week's top 10 stocks webinar that we do every quarter. It's by far the most popular webinar. It is a members only webinar, so you do have to be at least a trial member. And by the way, if you're not a member now, you can take out a $7 trial and we'll refund it. So literally it's a $0 trial for 30 days. So that would get you next week's webinar along with the next 30 days. But as you can see, the portfolios, we keep the portfolio, we keep it up to date. So this is as of Friday's close. We didn't have yet today's in there yet, but we do update it daily. I got to give Erin kudos for that. She updates this every single day. But these are cumulative returns since the inception date. So the model portfolio has been out now almost 15 months. It's up 54.39%. The S&P is up 23%. So it's outperformed by about 31 percentage points. Since May 19th, we added the aggressive and income portfolios. Now, the aggressive portfolio is down about a little less than 1% from the S&P, but that actually isn't bad when you consider that its component stocks have primarily been small cap and mid cap stocks. And if you've been following the market, small cap and mid cap stocks have been getting crushed by the S&P 500. So the fact that the aggressive is even keeping up with the S&P, I think, is pretty impressive. Income portfolio, these are household names that pay dividends. I'll show you how you can look at some of these names and all. But since May 19th, this group is up almost 6 percentage points above the S&P 500. That's pretty strong performance in just under 9 months, 6 percentage points. I think most portfolio managers would, I'm not going to say what they would do. They'd be pretty excited, I think, to have a portfolio that's 6 percentage points above the S&P. And it's actually designed with those large cap household names that I think kind of protects you in the event the market goes down. I mean, I would still expect to go down, but I think that this is a group that might actually outperform the S&P 500 if the S&P were to drop. So I actually like the group, and because it's a dividend paying group, might be more appealing to those who are on fixed income. It's not a huge dividend paying group, but probably 1.75% to 2% annually, in addition to obviously posting some pretty nice results. On November 19th, we started a new portfolio called the Character Change Portfolio. These are stocks that have been downtrending. They come out with solid earnings. They gap up. They break that downtrend. It's really a trial portfolio. I actually still think that this has a lot of promise, even though this quarter's been rough for the group. You can see it's been down about 8 percentage points. Also keep in mind, this is all small cap and mid cap stocks. So they're below what the small and mid cap indexes have been doing, but those indexes have not been doing what the S&P has been doing. So I'm not sure that the underperformance is nearly as bad as it might look at first glance. Now, the other thing that's pretty cool about this is that you can go back and take a look at the stocks currently. Right now, here are the stocks that make up the model portfolio. You could go back and look at the prior results by quarter performance, and see, which stocks were performing well and so forth. Aggressive portfolio is going to be since May 19th. So here's November 19th. This is what we have currently. This is August 19th, the stocks. You can see how they performed. And then back on May 19th. These portfolios are designed to be held for 90 days. That's it, 90 days. And then we're done. Now, some stick around. If you go back into the model portfolio, for instance, you will see Chipotle in this quarter. If you go back to the prior quarter, you'll see Chipotle. Go to the prior quarter, you'll see Chipotle. Go to the prior quarter, and you'll see Chipotle. Chipotle has been a great stock. And you can see originally this was bought back at $5.99 on February 19th of last year, so almost a year ago. And currently, we bought it this quarter at $7.66. I think it's up around $800 right now. So it's been a good performer for us, and it continues to beat earnings estimates, revenue estimates. So we haven't really felt the need to get rid of it. It might be in there again next quarter. Chipotle continues to perform well. So anyway, just wanted to let you know that these are in here. So you can always go back. You can check out these portfolios, how they've performed in the past, which stocks are in there now. Feel free to go through and check that out. All right, let's move on. And I want to talk now about earnings predictions. Last 2 weeks, we've had some earnings predictions. I'm not going to share the Excel spreadsheet. It's going to take too long. I really just don't want to get into that. What I will say is this. 2 weeks ago, when we came out with, I think, 40, maybe around 50 stocks, 44, I think, were bullish calls, and 8 were bearish calls. These were calls with earnings coming up. So in other words, we were taking a look at these companies saying, okay, the strength on this stock looks good. Relative strength looks good. We like its industry group. This is the kind of stock that I would hold into earnings, that I would be bullish going into earnings. Then the 8 bearish stocks from 2 weeks ago were stocks that were doing the opposite. They were either downtrending or they were just really bad performers relative to their peers or relative to the S&P 500 or both. And so those were ones, if we did anything, we want to sell, maybe short. Now, we're not shorting anything, to be honest, in this market. I think that's a waste of time to try and find stocks underperforming when you have so many that you can make money on the long side. And I would rather, the worst thing to me is shorting an uptrending market and losing money. I mean, it's like double loss, because not only am I losing money on my short, but I should be making money on a long. So it's really like, for me, emotionally, that takes the biggest toll. So I don't really short unless I am absolutely convinced that we're in a bear market. And we are in anything but a bear market right now. But, and right now I've just got the website on your screen. I just want to read you some of these numbers. So from those 44 bullish stocks, I kept track and I went through the week to see how they did. 38 of the 44 beat earnings per share estimates. 35 of the 44 beat revenue estimates, but only 26 of the 44 gapped higher. And of the 26 that gapped higher, the average gap higher was 4.2%. 18 gapped lower, and of the 18 that gapped lower, the average loss was 2.31%. Then when you look at the 8 candidates on the short side, or potentially on the short side, these are ones I would not have expected very good reports from. Of the 8, 3 beat revenue estimates and 2 beat earnings per share, and only 1 gapped up. 7 gapped down, 7 of the 8. So as you can imagine, I'm probably puffing my chest out a little bit after those calls. It was a really good calls, a bunch of calls, 52 of them. And if you had had $10,000 invested at the close prior to the earnings report, and you sold at the open after the earnings were out, you would have ended up making almost 10 grand total for all the positions. So not bad. I mean, considering you're literally getting in one day at the close and out the next day at the, at the opening bell. So you're not really holding very long. That's not a bad return. So I thought, okay, I'm going to do this again. So last week I did it again. And as you might imagine, the results were not nearly as good. And I probably just picked too many. I didn't go back and look at all of them. I picked 47 on the long side and 40 on the short side. I think one big mistake is picking that many on the short side in a bull market. Because even stocks that are downtrending, a lot of them did end up beating earnings. Not quite as high percentage as the ones I thought looked better, but still a lot of them did beat, a lot of them gapped up. And so it really didn't work out nearly as well last week. I'll just be honest. So I do think when you try to make a call, and I think that the rationale and the strategy makes sense to me. If the stock is trending higher and it's performing really strongly relative to its peer group, relative to the S&P, I think overall that's a pretty good signal that the company is likely, not guaranteed, but likely to report good results. But many of the stocks that I looked at that even reported good results were getting slammed after their earnings came out. And so that same exercise, taking $10,000 and investing on the long side for the bullish looking stocks, and on the bearish side, the short side, for the charts that looked bearish, would have lost 5,000 for the week. So made 10,000 the first week, gave half of it back the second week. What I do think that it does is it gives you a pretty high probability on a company beating its earnings expectations. So in week 1, and then we'll move on. I'll get some charts up. We'll take a look at some things. But just to summarize, those that were bullish, that I was bullish on in week 1, 2 weeks ago, there were 44 of them, and 38 beat their earnings per share. Last week, there were 47 bullish and 33 beat. So it wasn't as high a percentage, but it was still probably, I mean, that's, I don't know, 68%, 69, probably close to 70%. So it's a pretty good idea. Gives you a pretty good idea that companies are going to beat their earnings expectations. But of those 91 stocks, 44 in the first week and 47 in the second week, only 53 gapped higher. So the chances of actually making money on a good call still are, I mean, it's better than 50-50, but it's not exactly a slam dunk. So I think it's if you're going to hold a stock into earnings, I think it definitely makes sense to take a look and see how your stock is performing on a relative basis heading into that earnings report. But it is by no means a slam dunk. And I'm going to continue to look at this. In fact, I've got some charts that I want to show you. Some of these actually were reporting today after the bell, and then some others the next couple of days. But I'm going to go through and give you some charts. I was just going through Zach's upcoming earnings, and I pulled up some charts. The first 2 are actually stocks that are in our top 10. So in other words, they're in one of our portfolios. APPS, Digital Turbine, is in our aggressive portfolio. So I wanted to maybe take a look at that. But the first thing I would say is that from a price perspective, APPS held its support heading into earnings today. This is an area, actually I could probably just bring this down just a tad right here. So you got a breakout above $6. You come back, you test $6. Here we've had multiple tests of about $6, got all the way up to $9. It's been a rough last 2.5 months, and the volume's picked up on some of this selling, but we did hold on to this $6 area. And I'm going to look right now to see if what we have for APPS. Right now, I'm showing the stock down 23 cents after hours, and earnings came out 45 minutes ago.
Hey, Tom.
Yeah.
I had to throw this one in because I was watching it. It got down to 5 after hours.
Oh, it did?
Yes, and it rebounded all the way back.
Wow. Okay. We'll see whether or not, I mean, if it opens above 6, I still give it a shot here to hold on. Technically, I would not be liking this stock if it breaks down below $6 on a closing basis, because look at the relative strength versus software. It's in a great group, but it all of a sudden here over the last 2 months has lost its luster on a relative basis. And as I mentioned, you can see a lot of that's on pretty good volume. So it's not unusual to see a stock pull back when it's consolidating on a relative basis, because the group keeps going up, but the stock makes a new high here. So if it had just consolidated and gone sideways, it still would have lost some ground relative to the software group, because software kept going higher. But in this case, we had moved back. I mean, we're talking back to about 7-8 month relative lows. So that bothered me a little bit. And I talked about this earlier today at EarningsBeats. I do a show from 9 to 9:30, and this is one that I talked about. And I said, this is one I'd be a little bit more concerned about holding into earnings. So we'll see how it finishes, after hours today, and how it opens tomorrow, and then of course how it trades throughout the day. But this was one I was a little more concerned about. Now, the one I compared it to is the other one that was in the group, and I'm going to pull this one up. AMKR. Now, I thought AMKR looked a little bit better to me. It had pulled back a lot in the last 3 months, but it went straight up. Look at this move after earnings. The stock went from 11.08 all the way up to 15. And when I talked about this earlier, notice the close from last Friday was 11.08. Today it reversed back up off of gap support, and I just looked. It's up 14% after hours. Stock is back to 13.22, so all the way back up here. So I think right now AMKR is simply in a sideways consolidation mode. When you have a stock that goes from $10 to $15 in 2 or 3 days, sometimes you have to give it time to consolidate. I know, if you buy it at 15 or 14, you basically want to, you think it's the worst stock ever when it gets back down to 11. But if you're patient and you're looking at the key support levels and you've got that gap support still, it makes it a little bit easier to wait and see if you can get a stock like this cheaper. Again, going into earnings, if I had to bet, and I talked about it this morning, it's not like I'm just bringing it up now, AMKR was the one that looked better to me. On the selling, through a lot of this selling, look at the volume. The volume was much lighter on the selling. Now, when we broke down here recently, we did get heavier selling, but it was still nowhere near the volume that we saw on the way up. So this one, I was a little bit more bullish on. Some others reporting after hours tonight that I thought were interesting. I think they were after hours. Maybe some of these might even been this morning. I don't know. Probably be able to tell from the chart. MELI, relative to the specialized consumer group. I think that's what this one is. CS, specialized consumer services. Yeah. So relative to its peer group, you can see the strength the last 3 months, setting a new 52-week high. This one I would expect, if I had to make a guess, an educated guess, I would be on the long side going into earnings. And I see the stock is down $32 after hours. So there you go. Revenue beats, but apparently they showed a larger than expected loss. I'm just reading a headline off of Yahoo. Another one that I liked heading in today was RNG. RNG's been straight up. It's in computer services. This is a group that all of a sudden, I think IBM has helped to light a fire under the group. But this was one that I think's been one of the strongest stocks in the group for quite a while. Big gap up here with earnings, pulls back, goes sideways for a bit, but comes out with its earnings. And I'm going to pull this one up. This will be the last one I'll go over today. I'll give you a couple more for later this week. All right, I'm not seeing anything in after hours trading, but I do see tops expectations, revenue forecast above views. So I'm guessing that we'll probably see a gap up, but even that isn't guaranteed. I am seeing a bid of $218. The stock closed today of 212. So it looks like it's going to gap higher. But those were some that I thought were interesting today. Let's go into tomorrow and look at some of these that report. One is Hilton Worldwide. So this is what I look for. Here's a stock moving higher, been trending higher in a nice little consolidation period right now. You see how the group moved up. HLT is now at a 52-week high or close to a 52-week high relative to its peer group, the hotel and lodging group. So this is one that I think, because it's moved up and it's just consolidating, I wouldn't be surprised to see this one come out with a nice report. ACGL reports tomorrow. Arch Capital Group, nice sideways consolidation, couple of breakouts here. This is in the insurance, property and casualty insurance area. Here it breaks out on a relative basis to its peers. It just set a 52-week high. And then when I look down here, the group itself is starting to show some strength. And I'll talk about industry group relative strength in a bit. But this one is beginning to show some relative strength. Now, whether or not it holds, we'll have to wait and see. But we've got nice volume trends, really good relative strength. This is one that I would expect to have some good numbers. I put a question mark next to this one. This is in a very strong group, the semiconductors. And Lattice just broke out with some really nice volume. And I thought, okay, here we go again. It's going to break out, going to report really good numbers. And then all of a sudden, the last 3 or 4 weeks, I've been seeing selling. And the reason this is a big question to me is this is during their quiet period. This should not be Wall Street selling because they should not have any more information over the last few weeks, really since the end of the calendar quarter. So I don't really know what's going on here. Semiconductors, you can see when we got this breakout here, you see how Lattice was starting to turn back up again on a relative basis. So it looked to me like we're going to, okay, here we go, another big pre-earnings run. And then all of a sudden it pulled back. So I don't really know what the heck that means. And volume has not been light on this selling. Went from 24 down to 18, lost in two or 3 weeks, we lost a quarter of the company's market capitalization. And the volume was not light. So I don't really know what to make of this one. And when I'm not, convinced of something, I definitely would not be holding it into earnings. TGTX, another one that reports tomorrow. Look at this move over the last 4 months. Beautiful move up. Look at the volume trends accompanying this move to the upside. Really strong. It's in the pharma space, which has been uptrending, and it is clearly one of the best pharmas. And it's been killing the S&P 500. Now, pharmas overall, I would say, have been kind of just flat, kind of going along for the ride with the S&P. But we did move off the low in November. And you can see since November, the stock's really taken off. So it's been leading an improving group. That would suggest to me it's probably got some good numbers coming out. Next day on Wednesday, got a few for you on Wednesday, Shopify. Shopify, you can see software. Look at software. Software is just absolutely exploding to the upside. And I think one of the big reasons is these companies that can grow their earnings rapidly, like you can in software, again, getting back to this low interest rate environment with moderate growth, moderate GDP growth, that's really nirvana for these growth companies. So Shopify, if they come out with numbers, they could be looking at, Microsoft type moves, Tesla, maybe not quite like Tesla. Tesla's been crazy. Apple, Amazon, another gap up continuation move is what I would expect on Shopify. Moody's, MCO, check this one out. Since that October low, when the market started rolling, we have had a huge move here in Moody's from 195 up to almost 270. So what's that, $75 on 195? That's got to be close to 40%. Maybe just under, I don't know. But you can see relative to its peer group, it just set a new 52-week high. It's relatively, trading up versus the S&P. And look at the group versus the S&P 500 breaking out to new highs. So you got a strong group and one of the strongest stocks within it. Pretty decent volume trends. I suspect Moody's going to have a nice report. NLY, Annaly Capital Management. Great move here in the industry group, a great move in the stock relative to the industry group. You can see the industry group relative to the S&P just kind of going along for the ride. It's not setting any new lows, which is good, but you do have a very, very strong stock within this space. And it has just been a, head down advance. Not a single close in the last 4 months below the 20-day moving average. That's pretty impressive. So I expect a good report there. And then one other, Tyler Technologies, TYL, beautiful uptrend here. You can see the group, as I mentioned, computer services finally getting a lift. This stock's been breaking out to new highs relative to computer services for several months. And now all of a sudden the group is catching fire. And look at all of these hollow candles, 7 days in a row that we closed above the open. And now we're kind of consolidating in this flag. I suspect we're going to have a big report coming from TYL. All right, so those were the stocks that I wanted to mention going forward. Obviously, I'm not giving out 80 or 90 of them. That didn't work out very well. But those were some that I thought looked very interesting. So if you like the prospects of following along, these earnings reports based on how they're trading heading into earnings, that'll give you something to think about and consider over the next couple of days. And also, anybody who's in here today who is not already an EarningsBeats Digest member, we're going to have you set up. You can always cancel. You can, anytime you want to cancel and it'll be gone. But we'll have you set up Monday, Wednesday, and Friday. A lot of what I do when I write that is exactly what I'm showing you here. Looking at a stock that's trading, I'll say, hey, this company's going to be reporting in a couple days. This is how it's trading. Look at its relative strength, its industry groups picking up. And those are the types of things that I talk about. It's usually very quick, couple paragraphs, one chart, boom, something you can take a look at very quickly Monday, Wednesday, and Friday. Could be trading candidates. Could just be, an educational piece, however you view it. All right, I'm going to go ahead and take a break here just for about 5 minutes. I'm going to or a couple minutes, let John take over and show you the special for those of you who came in late. And I'm going to be back in probably just a minute or two here to go over some of the industry groups that are strengthening. And then I want to show you some of the stocks that I like off of the strong earnings chart list. Some of the better ones that are out there. I think you're going to see that many of these stocks will be in the top 10 next week when they are unveiled next Wednesday. So, John, I'll let you take it back a little bit.
Okay, so as soon as Tom gets back, he'll get into the last two topics, relative strength. They're going to be awesome to watch. And then some stocks on our strong earnings chart list that are definitely worth looking at. Let me just, one more time, I didn't really, wasn't able to go over it much before, but if you're already a member of EarningsBeats, you're in trial, or you're a monthly member, you might want to think about signing up for our annual deal. You just save a lot of money over the course of a year. And we found that people, work with us over the course of a year. It's 4 quarters. It gets you into a lot of events. And of course, next week on the 19th, we'll have our top 10 picks webinar. The other thing about the annual membership, and you'll get a better feel for that when Tom comes back, is to get you access to our relative strength industry group chart list. 104 industries. The reason we require an annual membership is because once you get this, you've got it forever. So if you happen to leave, you'll be able to take this along with you. It's updated in real time, lets you look at which groups in the industry are the strongest or weakest at any given point, which allows you to match up with our strong earnings chart list, which Tom will go over in a little bit. Anyways, take a look at that. And at a minimum, if you're not a member, just go right to our service here link and go down here, you can sign up for free. It costs you $7 to sign up. We'll refund the $7 to you. You get 30 days membership. More importantly, you get access to next week's top 10 picks event. You'll get access
Hey, John, I've lost you. I don't know if everybody lost you. I want to see if, Aaron, if you can let me know. Can you hear me?
I can hear you.
Oh, okay. There you are. You're back.
Yeah, I wrapped it up, so you're ready to go.
Okay. Because I know Erin was indicating she couldn't hear you either. So I think you went out for a couple minutes.
I think I went out for about 10 seconds. I'm good now.
Okay. Yeah, a couple minutes. I was being a little dramatic there. Sorry. Okay. So let's go ahead and start with this industry group chart list. I want to just show you. And this chart list, what John was just referring to, this has all of the industry groups on it relative to the S&P 500. And then when you pull this up, this is a 3-year relative strength list. So you can just see computer services, for instance, relative to the S&P 500 has been downtrending for the last 3 years. We go through these short little brief periods, the upside, but then we roll back over. This is what's been happening recently. We've been seeing some of this, and I think it was with Ring Central, RNG. I was telling you that it's been a great stock within this group. Well, the group is starting to show strength, but is it going to be different than it was at any other point? That's going to be a question, something we'll have to take a look at. Right now, you can see the relative PPO has turned back up, but we're still in negative territory. What I really like from these groups is to have the relative PPOs above the center line, have the relative strength line above the 20-day, and both of those above the 50-day. So the perfect configuration, I'll show you, actually I can probably go to the next one, the semiconductors. This is much better. So now I've got price action moving above. This is relative price action. This is not just the semiconductors. This is the semiconductors relative to the S&P 500. So when this is going up, you know that this is a group that's outperforming the S&P 500. So it's above its 20-day moving, or excuse me, 20-week moving average, which is above the 50-week moving average, and you can see the relative PPOs in positive territory. That configuration right there tells me this is a very strong group, and when I'm trading, I actually tend to migrate toward companies in the semiconductor area because this is a group that's been so strong. Well, anytime we get a pullback, a little bit of a relative pullback, the buyers come right back in. We've been seeing that now for the past 6-7 months since moving above this 20-week moving average. And so as long as that continues, if you're trading a semiconductor stock, you already have an advantage over a lot of other folks out there who are not paying any attention or don't understand where the relative strength lies. So really important. This is a really big chart list. I don't look at it every day. This is a weekly chart. So, there's not going to be a lot of change from one week to the next, but probably over, every 2-3 weeks, you ought to probably be just going through really quickly and just see what's going on with these different charts. So I'm going to just go through some of the groups that I think look, really good to me. And I'm going to start with some of the more elite charts. And I'm going to say semiconductors is certainly one of them. Semiconductors, like I said, been on fire. Down at the bottom of each of these charts is the absolute chart of the semiconductor group. So this is the relative chart up here. This is the absolute chart. So what we've seen here is this triple top breakout that occurred back in October. And that was another thing that just fueled, I'm a historian, and I always write about the fact that the stock market from October 27th at the close to January 18th at the close, that is historically the best time of the year to be in the stock market. So when you're seeing aggressive groups like semiconductors breaking out in the month of October, that is usually a pretty good sign that we are in for a nice rally. And not only were we in for a rally, but the semis have been leading the rally. One of the groups have been leading. Very, very strong group. Okay, software. Mentioned software. Look at the absolute chart. Another one. This one broke out in the beginning of November. So that was after the S&P had already broken out. Software comes roaring back, takes out the high. And since it broke out in November, look at what relative strength is doing. So yeah, the S&P 500 has been going up. Software has been killing the S&P 500 though. So if you want to outperform the S&P 500, you're probably going to want to be in at least a software stock or two. Computer hardware. This one I've said, probably is the best group. It's starting to, it's not weakening, I wouldn't say. I mean, it's just kind of going along with the S&P now. But look at this move. So here was a breakout back in September above this level. You go back to this high, and we actually broke out in the beginning of October there. So now all of a sudden you've got computer hardware breaking out in October, semiconductors breaking out in October, and software breaking out in November. A lot of this advance came after those three things happened. Got to be paying attention to these technicals for sure. And I wrote back on when the S&P broke out, I think it was right around mid-October, when it broke out above that 3,025 level, the pattern measurement was another 200 points. So that was 32.25. We've now, gone up another 100 and some points even above that. But there were so many things pointing toward a very strong fourth quarter, in addition to the historical patterns that we need to make sure we're aware of. But computer hardware has been on fire. So again, if you're going to try to beat the S&P 500, it certainly helps to have Apple, which has been one of the best stocks in this group. Now Synaptics, by the way, which I put in the daily market report today. It was pulling back, but it broke out with very, very strong earnings, and that's a stock that could be a leader for the next 3 months. Let's go to home builders. Well, low interest rates and probably going to stay low for a while. Look what that's doing to home construction relative to the S&P 500. Just broke out again on a relative basis to a new high. It's above the 20, which is above the 50. PPO's positive, and we've now gotten a breakout here above the 2018 high, above 1,000. So it is on a roll to the upside. So here you've got another very strong group. These are the groups that I'm kind of thinking are kind of at that elite level. Next up, automobiles. And I never thought I would say automobiles and elite in the same sentence, but this is because of Tesla. Tesla has exploded to the upside. I think that, that company's got two things going for it: a breakout, well, three things: a technical breakout, a short squeeze, the mother of all short squeezes, and very, very strong earnings growth. And again, in this kind of an environment, it's what people just don't get about Tesla. If you're waiting for Tesla to come back down to 300, I have a feeling you're going to be waiting a long, long time. I'm not sure Tesla's coming back down to 300 ever, unless the company itself just falls apart. I mean, if this kind of growth continues, I would not be surprised to see Tesla quickly back up at a new high. Let's see. But, look at the relative PPO above 6. That's crazy. I mean, this is a group that definitely could use a pause, but it's going to be kind of riding the wings of Tesla. Next up, internet stocks. Mentioned internet stocks quite a while ago. When we made this is another group broke out in November. So here was the breakout, getting above these prior highs. And look at this move since it broke out. That measured from, roughly 1850 down to 1350, 500, well, probably 525 points. That measures to 2,400. We're at 2,100 now. It's been straight up, but I don't think we're there yet. So I'm looking for yet another breakout on a relative basis. You can see the PPO's higher, the relative price action above the 20, above the 50. Next up, defense stocks. Now, defense is pulled back, but I think it's an opportunity. This is an overall group that I see going higher. This pullback held this low, this relative low here, and started turning back up again. The PPO went positive. The relative price action above the 20, above the 50, and check the breakout. So it's got that absolute breakout as well. And then the last one that I have in this kind of elite area is the specialty finance group. And you can see the PPO turning back up again at 2.5. Relative breakout again recently. Look at the strength here on an absolute basis. Really, really strong group. So when I'm looking through the strong earnings chart list, I know these 8 companies, or these 8 industry groups are ones that I really want to focus on because this is where the money's been flowing to. And you might say, well, it's probably extended. Well, we probably could have said that back here or here or here or here or here. I mean, you just sit there and you never you know, it's just analysis paralysis. You just stare at it and you don't do anything. I think it's really important to listen to what the market tells you. And so those are 8 industry groups that until the market tells me otherwise, they're going to be up there very high on my radar list in terms of what stocks to trade. I'll go over a couple more of these. I'm going to bring up another. I'm going to bring up the scooters. So if you're in stock charts and you look at the scooter reports, large caps, it's in scooter order. I want you to take a look at the ones, the groups that we just talked about, and look at the ones, the stocks that are have the highest scooter scores. Software, semi, computer hardware, home construction, software, home construction, railroads. That one's an improving group. Semiconductor, specialty finance. But you can see the top 10 are almost all in those groups we just talked about. One exception here is Biogen, which has just taken off here recently. That's a biotech. ABBV, actually, this is a really strong looking stock in biotechs. Biotechs are the next group we want to watch because I think biotechs are getting ready to explode to the upside. We just keep coming up to this 2,000 level, or excuse me, 2,200 level, and have been unable to get through. But let's talk, I'm going to go back and look at some more of these groups. So here are some strong groups. I wouldn't put them in the elite category, but these are some pretty strong groups. So let me go back and find them. First one, broadline retail, and you got to thank Amazon here. Getting ready to move back up above that 0 line. Huge move up, though, with Amazon's earnings. Back up above both the 20 and the 50. I think it's just a matter of time before the 20 comes back up. Look at the breakout. So we're just making this breakout above the 2,100 level, and this actually measures up to me to about 2,750 to 2,800. And we're sitting at 2,234. So I think there's a lot of room to the upside. I really like Amazon, and I think the broadline retailers here are going to have a tailwind behind them for some time. Next up, footwear. Footwear's pulled back. You know, we had this high back in October. It's kind of gone sideways for a bit, but it did make a breakout. It's pulled back. It's holding the area that it broke out from. It's holding above its 50. It's kind of between the 20 and the 50 right now. PPO still positive. I think it's just consolidating. I'm looking for another move up. Recreational products. Now, this one had been in a downtrend for a while, but it came back up. It took out this prior high. It went below the 20, came back up above the 20. So we've now got relative price action above the 20, above the 50, and the PPO is positive. We have been trending higher, but we do have overhead resistance that we'll need to negotiate. But still, I think this is a group that is still on the improve. Now, if it were to roll back over and lose this low and go back below the 50 and we see the PPO go negative, chances are this prior downtrend is going to kick back in again. So it's not one that I would just, it's not nearly as attractive as, say, you know, semiconductor, software, computer hardware, those types of group, home builders. But it is definitely an improving group. Let's see. I'm going to go into the publishers. Publishing index. Look at this relative breakout here. We've already gotten the price breakout. This one's been on fire. But finally, we got a breakout in terms of the relative strength. So I think, was it, let's go back over here for a second. So I looked at MCO. Now that was in specialty finance. I thought maybe this was in the publishing area. But anyway, specialty finance is strong as well. But here's your publishers breaking out. So owning a stock that, say, is a strong relative performer to this group would be very good, because this is a group that's outperforming the S&P 500. And it's been in this uptrend now. It's pretty volatile, but it's been overall in an uptrend since bottoming back at the end of 2017. It's been a pretty good group. All right, let's go with insurance brokers. You can see this one just broke out on a relative basis. Absolute chart looks awesome. The PPO got back down to the center line, but it's starting to strengthen again. Clearly, this is one of the areas that we want to kind of keep an eye on. Also in this space in the financials, financial administration, been a very strong group, went through a little consolidation. I think it's starting to turn back up again, though. It's above both moving averages. PPO just turning positive. We've gotten the recent breakout. Financial administration looks good. Then we've got the consumer finance, huge outperformer. I think a little bit of a maybe relative cup handle. Watch for the breakout here. It looks good on an absolute basis. Notice the relative PPO again came down close to the center line, starting to turn back up again. All right, how about the healthcare providers? Had a big strong move in November, October and November on an absolute basis and on a relative basis. The group continued moving higher, but not as fast as the S&P, so it started to roll back over. I want to see whether or not it holds the 50 and maybe gets back up above that 20. That would put us back in the proper configuration with a PPO that's positive. Medical equipment. This one is a little below on these. You see the PPO's gone negative, but we haven't lost this relative support, and I still see a nice uptrend here. I'm not ready to give up on this medical equipment group. I would watch this support here, relative support. I think as long as that holds and we start to turn back up again, I'm actually pretty okay with the group. And then I also wanted to mention the biotechs. So the biotechs right near the zero line here. We went positive, went back negative. We didn't go below these prior lows, and now on a relative basis, these last 2 weeks, we're moving back up again. But what I'm really watching, we had this one quick move above 2,200, but I could probably go back, let's go back 7 years. And here was a move up near 2,200. This was quickly above. Here was near 2,200, near 2,200, near 2,200. And actually today's close, 2,197. I mean, we could be on the verge of a very significant move to the upside. And anybody who's looking back at the last 4 or 5 years says, well, biotechs always underperform. Don't remember the last time they outperformed, which was 2013 through 2015. When it went straight up, believe me, this was kind of like having computer hardware right now. That's how biotechs were back in those years. If we get this absolute breakout here on the biotechs, this could be a big push to the upside. The other thing that this could trigger is small cap strength. Because let me show you, let's go back over to that Scooter report. I want to show you, if you look at the Scooters, and then let's pull up small caps, check out what's at the top here. There are so many small cap biotech stocks. If the biotechs break out, I think you're going to see a lot of money flowing into these small biotechs. And small biotechs can really carry the small cap 600 and the Russell 2000. So this is an area of the market that we really want to watch. Biotechs, Vertex is in our model portfolio, VRTX, and Amgen right now is in our income portfolio. I had both of those in last quarter because, again, I'm watching the biotechs. I want to have representation if this group breaks out, and I think they're going to break out. So you'll probably see at least a couple more biotechs in next week when we go through the list. All right. That's about it for those. So I'm going to wrap up now. It's going a little longer than I thought, but I'm going to go through and give you a bunch of stocks off of the strong earnings chart list that I think look pretty interesting. I don't know, maybe have a couple dozen of them for you here. So let me get back to the strong earnings chart list. And let me see, I'm going to go down these in order. Let's see if I can find it. First one's Winnebago. So Winnebago, look at the huge volume back in December. We had big move up in October, sideways consolidation, big move up in December with the gap up that was earnings related, pulled back, hit the 20-day, and we just keep moving higher. Volume trends remain strong. And this is in the recreational products area, which I talked about as being one of those groups That's certainly not the top tier, but a pretty strong area of the market. And look at Winnebago relative to the group. So you got one of the strongest stocks. That's the kind of thing that you're going to want to be looking for, and the kind of thing I'm looking for when I fill out the portfolios next week. Next up is SNX, which is Cinex Corp. This one, nice reversing candle today, a piercing candle. It wasn't a huge downtrend that it came in, but you can see the last time off the downtrend, you see that piercing candle right there, and then we went up for 3 or 4 days before coming back down. I think we're going to make another run back above 150 on the stock. So I like it. Nice volume trends. Look where it is, computer hardware. So the group or the stock on this move higher right here had a quick surge in relative strength, but now it's consolidating. And while it's consolidating, we're starting to get this pullback. I think we could see another pushback to the upside, though, here with SNX. Now, to the downside, clearly the bottom of gap support is where I would draw my line in the sand. I don't want to see the stock closing back down below that level. All right, next up, how about Morgan Stanley? Morgan Stanley, big volume. Look at that, biggest volume going back the last year. Big volume, gap up, came all the way back down, filled the gap. I marked 2 areas of support. We went just below the first one, started to turn back up again. For those of you that are new to EarningsBeats or haven't been in here, another big positive for individual investors has been the zero commission trade environment. So you don't have to pay for commissions anymore. Before, what I would have said is maybe, you know, buy at 52.5, and if it gets down to 49.75, you know, you buy a second batch. Well, now you literally could buy at 53.50, or excuse me, 52.50, and then buy every 50 cents down until you fill out your position. Why not? No commission. One of the dilemmas was, well, what if it gets, you know, before was what if it goes below 53, gets all the way down to 50, but doesn't quite hit 49.75? Well, that's, you know, what happened. I mean, you had to pay a commission every time you placed a trade. So you wanted to be careful how many trades you placed. Now you don't have to worry about it. So if I see a key area, a zone of support, I mean, okay, maybe here I would have only gotten 2 out of 6 entries or 2 out of 7 entries. Well, I still would have made money on it. I'm making money on the position no matter how many shares I have, and I'm not paying commission. I actually had a discussion with my brother recently because he always puts in his orders for all or none. So he'll put an order in. One day he got rejected. He had 200, he wanted to buy 200 shares of a stock, trading about, I don't know, $30. And he had 200 shares, all or none, just for, you know, an example purpose. Let's say it was $30. Well, the low that day got down to like $29.98. He didn't get his shares. So he called me and I said, well, I don't know. I said, probably the bid and the ask straddled your order. And, you know, and that's probably why it didn't go. Well, then he calls me back and he said he talked to his broker, and his broker said that 198 shares traded at the price, but because he had all or none for 200, he didn't get the trade. And 3 days later, the stock was at 33. It was up 10%. And I told him, I said, you know, this is a different environment. I said, you know, you don't have to pay for commissions anymore. Why are you putting in all or none? I understand when there's commissions, because that would be frustrating. You put an order in for 200 and they give you 10 shares and then charge you commission on it. And if it goes back down again to that same level the next day or whatever, you have to pay commission again. I get that. But now you have no commissions. So you got to be thinking about, you know, little different strategies in building up your positions. Anyway, that was Morgan Stanley. Let's go down to Teradyne, semiconductor. Look at the gap up with earnings. Black candle, that usually means trouble ahead, short term. Well, we came all the way down. We went through the first area of support, which was this breakout level, and went all the way back down to this area of support, which was the low back in early January, and then tested it again. Now we're bouncing. Nice candle today, though, piercing candle there as well, but fairly light volume. I suspect we're going to make another run back toward $80 on Teradyne. Do we go to 66 again one more time first? Maybe. Do we break down? I mean, it's possible. But the stock after earnings was trading over 80. Now I can get it at 70. A week ago, I could have gotten it at 66. You know, use these pullbacks. It's very easy to monitor these trades with this strong earnings chart list. All right, next up, another semi. How about Intel? Intel is probably going to find itself in one of the portfolios. It might be in the income portfolio again. It broke out to a new relative high versus the semis. Of course, semis are strong. Intel, you know, got a lot more clout than some of these small cap stocks or smaller semiconductor stocks. So Intel is one that kind of gives you a little bit better feeling. You know, if you're going to own a semi and you're a little bit risk averse, then I think Intel makes more sense than some of these other smaller semis. Let's see, the next stock, I think you've heard of it. Apple. You know, if it ain't fixed, or excuse me, if it ain't broke, don't fix it, right? We know that saying. And here you got Apple going higher. Thing that bothers me a little bit is we've got this negative divergence as it moves up. And the last breakout attempt, you can see the volume's been coming down. So maybe we just need to consolidate a little bit. But I wouldn't put it past Apple to break out again. I mean, it's just, it's one of those stocks growing earnings very rapidly, and the market is paying up for earnings right now. Next up, AMD, another semi. I mean, this is what a great company this is. Up 5% today, broke out to a new closing high. And you can see on a relative strength basis, broke out to a new high versus the semis. This one's a lot more volatile, a lot riskier than Intel, but it's been a lot better performer. Next up, Lockheed Martin. I mentioned defense being a pretty strong area. Look at Lockheed Martin breaking out. Look at the relative strength, 52-week high versus the defense group. These are the type of stocks I think you want to have working for you. Let's take a look at Pulte. Pulte is in that home building space. Look at Pulte's move to the upside. Look at the relative strength. Just broke out to a 52-week high versus home builders, and home builders are at near a 52-week high relative to the S&P. Strong stock and a strong group. Let's see. Sorry, there it is, GE. Another one I wouldn't have thought I would have said this about, but GE looks like a really strong uptrending stock right now. It is in diversified industrials, which trying to make another breakout here. On a relative basis, this is not one of the strongest areas, but it is one of the strongest stocks within the area. So if all of a sudden the group starts to outperform, then GE is definitely one to give a lot of thought to. Let's see, another one I think you've probably heard of, Microsoft. Stock is just going straight up. You know, if you're watching Microsoft, you're saying, wow, I'm just waiting on a pullback. I'm telling you, a lot of these stocks that are growing earnings rapidly, as more and more of the market realizes what's going on here, I'm not sure we're going to get a huge pullback. If we didn't get one last month, when we saw equity-only put-call ratio or readings go down to the 5-day moving average, the reading of the 5-day moving average of the equity-only put-call ratio went to the lowest level, or one of the lowest levels in the last 15 years. All that could get us was about a 3% drop in the S&P 500 and right back to new highs. I think that's telling you something. Sentiment, very, very bullish. All right, next up, been in the news quite a bit. Tesla, look at the volume. I mean, the short squeeze is, it's real. But move up, we might see a triangle. I've been kind of watching to see maybe if a triangle, symmetrical triangle develops and maybe test the 20-day. Hold on one second. So we'll just have to see whether or not Tesla pulls back at all. But I wouldn't be surprised. And I said in a webinar, I've done so many webinars, I can't keep track of which one. But I said probably a few weeks ago, maybe it was back in here sometime when Tesla was 500. I said Tesla might go to 1,000 before you get any kind of meaningful pullback. And maybe it's higher than that. I mean, we went up to 960. Maybe we go to 1400. I don't know where we're going on Tesla, but Tesla, everybody, there were a lot of shorts betting against it. They couldn't make any money. And now all of a sudden their earnings growth is exploding. And you've got all these folks that are short and got to make some decisions because you got unlimited losses when you're shorting. When you're long, you can only lose how much you put into the stock. But when you short, the sky's the limit for your losses. That gets pretty scary when you're sitting in a stock that's short, or you're short a stock that's going up like Tesla was. Let's see, a couple of others. Let's go check out Amazon. I really like Amazon. I actually own Amazon. Big breakout above the prior highs. This thing measures very, very high. I mean, if we look at a 5-year weekly chart, the equal highs coming across and then the higher lows, you got an ascending triangle. The breakout here measures from 1,300 up to about 2,000, maybe a little more than that, at least 700 points. So I'm thinking Amazon's going to 2,700. That's the initial measurement. Pretty nice move if we can get that. Let's see, next up, Coca-Cola. Soft drinks. I didn't talk about soft drinks, but the group is starting to show some strength coming off the low in January. Coke is one of the strongest, and it has made an absolute breakout, by the way, in January. So as it made this absolute breakout, that's when the relative strength picked up. That's what I was talking about on the biotechs. If we get that absolute breakout, we could see that relative strength really start to pick up. But Coke has been a very strong performer in this area. Let's see. How about, I mentioned Vertex Pharmaceuticals in the biotech area. Let's see what it looks like. Look at the relative strength versus the biotechs. Very strong. So, and it's outperforming, set a new relative high to the S&P 500 today. Biotechs, if we get this breakout, and it's showing a breakout on a closing basis there on a weekly close. These are weekly charts. Or actually, no, this is a daily chart. I didn't think it broke out above those prior highs at the end of December, but maybe it did. I know going back 2,200 was that big level, but anyway, we're right there. Tomorrow could be a big day for biotechs. Let's see, what else do we have here? How about Aon? Aon Corp, nice breakout. It's in the insurance brokers. I mentioned insurance brokers is one of the strong areas. And there you can see on a relative basis making a new breakout, and Aon relative to the group making a breakout on big volume. So Aon looks good. Next up, Charter Communications, CHTR, making a breakout. This was the reaction to its earnings, these two candles here, end of January, beginning of February. Nice volume, breaking out, relative basis, breaking out versus the broadcasting group. The problem is broadcasting. So it's a nice chart and good relative strength, but the group itself is lacking a little bit. So that tempers the bullishness that I have for the stock, but it's still a very strong performer. Let's see, I mentioned Chipotle earlier. Let's pull this one up. I said it was around actually it's almost 900 now, 890 today, 890.51. I think when we first put it on the model portfolio just under a year ago, it was 5 something. Now it's 890. It's been a strong year for Chipotle. Restaurants though, struggling down near 52-week low, but you can see Chipotle is actually at its highest level versus the restaurant. So it is the top performer, and it has actually over the last 3 months been outperforming the S&P, even though the group has been underperforming the S&P. Let's take a look at a few more here. PCTY. I should be done here in the next 5-10 minutes. So we'll try to wrap this up by 6. PCTY on a relative basis, look at it, it's in the software group, and it was near a 52-week high. Buy on rumor, sell on news. There was the earnings coming out. Went all the way back down to this prior low. Now it's rallying back again. I like the stock. I think we're going to get another breakout. I think this one probably is going to help to lead software higher. TransDigm, TDG. This is one of the strongest stocks in the aerospace group. Aerospace trying to come back to life here. And look at the stock relative to aerospace. Really a huge move up in the first half of January. And it's pulled back a little bit as it's been consolidating here. Again, remember, consolidation results in a lot of times relative weakness for a period of time. All right, let's do 5 more stocks. Let's go with Nuance. Nuance Communications. This is one of my favorite candles. Just open at the low and just take off all day long. Follow it up the next couple of days with more buying. Look at the volume here on this push. I think Nuance looks really good. It's in the software area, and it just broke out to a new 52-week high relative to one of the strongest groups. And look at all that volume coming in. Nuance is going up, and it's going up for a reason. Another one, I believe, in this same space. Fortinet, FTNT, made another breakout in January. You can see on a relative basis, set a new high. And now as we consolidate, we're losing a little bit of relative strength. But I still believe this one is going to turn back to the upside. I would be watching these support levels if we get back down there. All right, NLOK, this is Norton LifeLock. Big gap up, there's earnings. Big gap up with earnings, nice volume. Relative strength just took off versus software. So another one, very overbought, but it's in that software space. I think when I annotated this, because it had today's action, I didn't know whether we would continue. If we break out above the high, that intraday high from Friday, that would be really bullish, and I would raise one of these support levels up to the 19 level where we opened with that candle. But right now, I wasn't sure what might happen today, and I annotated these over the weekend. So if we pulled back, went below 19, that's why I wanted to use these 2 as support levels. But that 19 level could be a very critical support area. All right, last 2. I mentioned Synaptics earlier. So here is Synaptics. Big move up. When it pulled back earlier today, I think it was around 81.80, 81.90. I put it in our daily market report that I send out every day because I said I don't know how much this one's going to go down, but I doubt that it goes below 80. That would be a key area of support to watch first. If it did move below 80, then I think you've got the breakout above the prior high of 75 that comes in as support. And then the last one I mentioned earlier in the biotech area, AbbVie, broke out here and continued that move today. I can only imagine with a stock that's breaking to a new relative 52-week high versus the biotech group, if the biotechs continue their role and we get this breakout, I think stock like ABBV, VRTX, and some of the others in that space are likely to make a big push to the upside. All right, that's it for me, John. So next Wednesday, 9 days from today, we will be announcing the top 10 stocks for each of the 4 portfolios. Many of those stocks I announced next week will be coming out of stocks I've just talked to you about today. I don't know which ones will go in which portfolios. Not all of them will be picked, but probably a lot of them will. And then we've got a lot more earnings reports coming out this week. So anybody reporting this week or early the following week could also be selected, but probably this week. I'll probably cap it to the end of this week. So, but that's it. So I think I'm done. I don't know, unless you have something to add, John. I think we're good to go.
Hey, Tom, John dropped off. So if you want to just give your closing remarks, that would be great.
Okay, sounds good. Yeah, it's, the market, like I said, from a guidance perspective, everybody would love to see a pullback. I'm not sure how much of a pullback we're going to get. The market just wants to keep going higher and higher. The NASDAQ breaking out again. I think you've got to be willing to pay up. I think that's what Wall Street's doing right now. I think they're paying up for earnings on a lot of these companies. Not every stock is going to just take off. We have 269 stocks on our strong earnings chart list. There's not a need to chase the 20, 30 stocks that are breaking out every day. There are others that are pulling back, but you just can't wait until they break out to then say, oh, yeah, they look good now. When you get them in these pullbacks, 20-day test, gap support test, recent price lows, those types of things, that's when, you know, those trades are going to have their highest reward to risk opportunities. So let's go ahead and wrap it up for today. I appreciate, again, all of you coming in. If you're not a member, I would highly recommend that you at least take a trial for 30 days. Come join us next Wednesday. Get the top 10 stocks for each portfolio. If this doesn't work out for you, you know, EarningsBeats doesn't work out for you, nothing lost by checking us out. Everybody have a great day, and I'll be back tomorrow morning at 9 a.m. on Stock Charts TV. Join me there. Everybody have a great evening. See ya.